Part of the trading plan money management series. Okay, um actually I promise to create a weekly outlook content on different pairs, but as it is right now, um I'm already having a busy week. Okay, so I'm just scheduling time out to create the final series on the trade money management. But I promise I'm going to fulfill my promise on it actually maybe next week. But for this week, I don't think uh, I actually have the time to create that content anymore. Okay, but I'm really sorry for those of us that we are expecting it. I'm really sorry. I'm gonna make it up to you guys, I promise. Okay, so let's just get started to today's business. And please, if this is your first time of coming across this channel, please subscribe and like this video. If you learn something from it, please leave a comment behind. Okay, leave a comment below. Right, so now we're going to be looking at, let's say, a $50 capital account. Okay, so our risk per trade will be 15%. Okay, our risk per trade will be 15%. So that will give us $50 our capital times of risk per trade divide by 100. Okay, so that means we are risking a total $7.5 per trade. Okay, so we are risking $7.5 per trade, and remember our risk to reward ratio is a minimum of 2. In other words, risking 7.5, we are expecting a minimum return of at least it should be close to $15, if I'm not mistaken. 7.5 times 7.5, okay, that's times 2 of the risk we are putting on each trade, right? So now our value per peep, know how to know your value per peep, how to know the what each peeps cost. Okay, the value of each peeps, that will give us our decimal place multiplied by our maximum lot size. Okay, we are using the maximum lot size we are using on a capital of, on a $50 capital account, is 0.4. Okay, that will be, remember, that's a micro lot size, and each unit cost 1000. So 0.4 will actually give us 0.04 will actually give us 4000 units. Okay, so that's 4000 units of the base currency, in this case 4000 units of euro, right? So divide by the current market value. Okay, so your current market value will be the bid price on the current market chart of that particular day. Okay, so this was just a random one. Okay, so now on the platform, depending on the platform you are using, you use for trading, okay, the values are going to differ. In other words, we have some platforms that are approximated to 4 decimal places, but for those of us using MT4 for our entries, MT4 is approximately to 5 decimal places. Okay, so now this is the pipette. Okay, this is the pipette actually. Okay, so now divide by this. So each movement right here is costing us 0.35 cent per pip. Okay, so now this is the, now we know the value per pip on each move. Okay, so now you multiply the value of each pip times the total number of your stop loss. In this case, we are having a 20 pips fixed stop loss. Okay, so I'm just creating this. I'm using the fixed stop loss in the sense that your stop loss is going to vary, right? So in the scenario, if you have more than maybe 30 pips stop loss, the best thing to do is to reduce your lot size. Okay, so the higher your stop loss, the lower your risk per trade. Okay, your risk per trade, you should reduce your risk per trade if you are having a low account. Okay, so no matter what you do, your risk per trade should not exceed the 15% of your capital, right? So in other words, if you have a stop loss of, let's say, 30 stop loss, what you're actually going to do is to, once you determine your value per pip, you multiply by the total number of stop loss. If the outcome is bigger than your risk per trade, then you have to reduce the lot size. Okay, so let's say multiplying this, I actually got $8 instead of 7 point instead of 7.5. Okay, that's actually over my risk per trade. What I have to do, I have to drop this. I have to drop this lot size to 0.3 lot size instead. Okay, so now that is just how you work around with this trading plan money management. Okay, so that will be, so in this case now we have a fixed stop loss of 20 pips. Okay, so that is 0.35 cents, which is per pip, our value per pip multiplied by our stop loss. So this is the total money we are putting in the marketplace. Okay, so and our risk to reward ratio in terms of profit target is actually times 2. Okay, so that will be 7 times 7, right? That's a minimum we are risking this $7 for. So we are expecting a return of $14. Okay, that's just a crude example of what I'm trying to say. Okay, you can have multiple, you can have 5-to-1 risk reward ratio, you can have 10-to-1. Okay, it depends on your entry, depends on your strategy, depends on the price action you are looking at. Okay, I'm just creating a crude depiction of what you should expect. Okay, so now in this case, for the yen pairs, okay, for the yen pairs we have a $50 capital, right? A risk per trade is 15%. Okay, so that will give us our capital times our risk per trade divided by 100, right? So we are risking $7.5 per trade, right? So for our yen pairs, remember they are approximated to 2 decimal places, right? Multiplied by our total lot size, which is the 0.04. That's the maximum lot size we are using on a $50 account, which is the 4,000 units. Okay, which is 4,000 units divided by the current market value. Okay, so the current market value for USD is 128.414. So that will give us 0.31 cents per pip. Okay, so now you multiply it by your total stop loss, 20 pips. That will give us $6.2 per pips. Okay, no, that was give us $6.2. So what this means that if our stop loss actually gets taken out, we are going to be losing $6.2, right? So that is just that, and $6.2, and we are actually risking the whole, we are actually risking per trade $7.5. Okay, so $6.2 is nowhere close to our percentage that we are willing to lose. Okay, so that is just still fair enough, right? So now for a $100 capital account, we are risking 10%. Okay, we are risking 10% of the capital. Okay, so taking a look at this, you will notice that the more our capital increase, the lower our risk per trade drops. Okay, so now we have 10% and we have $100 account, right? So multiply by the risk per trade 10 divided by 100, so we are risking $10 per trade. Okay, so now value per pip, our value per pip will be, what's the decimal place for a non-Japanese yen pairs is into 4 decimal places, right? So the maximum lot size we are using for $100 account is 0.6. Okay, so that will give us 6,000 units. Okay, so that will give us 6,000 units. Okay, now divide by the current market value, that will give us 1.13101. That will give us 0.53 cents per pip. Okay, so each pips movement is costing us 0.53 cents. Okay, so now multiply this by your stop loss, so that will give us 10. It's actually over by some cents. Okay, so that's about 10.5 cents if I'm not mistaken. Okay, so and we are willing to risk the $10, right? So in this case you can drop your lot size to 5,000 units instead. Okay, but I'm just leaving this because the fraction was not that much. Okay, so now we have our risk per trade. Okay, so now if we get taken out, if our stop loss get taken out in this example, we are going to lose $10. Okay, so we are risking $10 to make back 20. Remember, our risk to reward ratio is a minimum of 2. Okay, so that is just that for that. Now for Japanese yen pairs, okay, for Japanese yen pair, we're having capture of $100. Our risk per trade is 10%. Okay, our capital multiplied by our risk per trade divided by 100 will give us $10 per trade, right? So we have a two for our Japanese yen pairs, we have 0 point to 2 decimal places, right? The maximum lot size of 6 divided by the current market cent per peep. Okay, so each peep is going to cost 46 cents, right? So multiply by your stop loss, that will give us $9.2. So if our stop loss gets taken out, we are actually going to lose $9.2 instead of $10. Okay, so now going to a $200 capital account. Okay, so our risk remains the same. We are risking 10% per trade. Okay, you can actually reduce this to 9% or 8%. Okay, so but this is just fair enough. Okay, so now 200 times our risk per trade divided by 100. Okay, that will give us $20 per trade. We are risking $20 per trade. Okay, so now value per peep. The value per peep is very important. You know your value per peep so that you actually know what each peeps move is going to cost you. And remember, this is not fixed, right? It might fluctuate. On It's not actually fixed. Okay, doesn't mean that. What I mean is that you using this exact lot size doesn't mean this each pip is going to cost this. Okay, it might differ, right? It might differ. Okay, so now the maximum lot size we are going to use is 0.11. Okay, now we have moved from sorry, that's 0.11. Okay, so now we are actually moved from what is it called, we have moved from a micro lot size to a mini lot size. Okay, this is actually supposed to be one. Okay, this is 1100. Okay, so now we are using 0.11. Okay, we are using 0.11. So now multiply this by your market value, you get 0.97 cent per pip. Okay, so now we have multiplied by your pips, we have $19.4. Okay, so if we actually get taken out on this, that means we are losing this amount right here. Okay, so now sorry, this actually ought to be 11,000, because you know a mini lot size costs 10,000 per unit, right? So I actually made a mistake here. This ought to be 11,000. So how do we arrive at 11,000? Okay, that was what I was trying to explain earlier. If you have a 0.0, sorry, if you have, between 0.01 to 0.09 is a micro lot size, right? And between 0.010 to 0.099 is a mini lot size. Okay, so now each mini lot size is 10,000 of the units, right? So now we're having 0.11 in this example. Okay, let me quickly go up and show you. Where is the $500 capital? Sorry, let's go up. Okay, $200. As you can see, our maximum lot size is 0.11. Okay, so how do we calculate this now? You take you have one, the figure right here on the left side represents the mini lot size. The figure on the right side represents the micro lot size, right? So how many figures are we having on the left side that represent the mini lot size? It's just one. That is, and one unit of a micro lot, a mini lot size costs 10,000, right? So you bring out the 10,000, and then how many figures, what figure are you having on the right side that represents the micro lot size? Is one, and one micro lot size is 1,000 units of the 1,000 units of the base currency, right? So what you do, you add 10,000 to plus 1,000, that will give us 11,000. Okay, so that's how you arrive at this figure. Okay, sorry, that's how you arrive at sorry, yeah, wait, this is a 500. That's how you arrive at this figure. Actually it's corrected here, but I made a mistake here. It ought to be 11,000, not 1,100. Okay, so that's how you arrive at this figure. So if we were having 0.012, that would be the figure on the mini lot size. You add the figure on the mini lot size, the figure that represents the mini lot size. Okay, you add it, and the one that represent the micro lot size, you add both together. Okay, that will give you the figure you will use here. Okay, in this our second example on the euro, on the USD JPY, we see it right here. Okay, so we have a $200 capital, risk per trade it's 10%, right? So $200 times 10 divided by 100, that will give us $20 per trade. So our value per pip So remember our decimal point for yen pairs is two decimal places, right? So we have 0.01 times our lot size, which is 0.11. Okay, so 0.11, we have one representing the mini lot size, and we have the other one representing the macro lot size. Okay, so uh we add 10,000 of the 10,000 units, or 10,000 units representing the mini lot size, and the 1,000 units representing the micro lot size together. Okay, so that's what actually gave us this figure. Okay, so that will be us risking 0.85 cents per pip. Okay, so divide by current value will give us this, and multiply by stop loss will give you 0.85 cents times 20 pips. That will give you $17.13. Okay, that is still below our risk per trade. Okay, so I hope I'm making this clear and making it understandable, right? So now our next capital is $500 account, so our risk per trade is 5%. Okay, $500 times 5% divide by 100 will give you risking $25 per trade. Okay, so now our value per pip is for a non-Japanese pair. In this example, we have Euro USD. That will be 4 decimal place. Another mistake right here. This ought to be 14,000. Sorry, this ought to be 14,000. Okay, so our maximum stop loss we are using is 0.14. Okay, you can see that here on a $500 capital, right? So our maximum loss size is 0.14. So this figure 1 right here is representing the mini lot size, and this figure 4 right here is representing the micro lot size. Okay, so remember we have 1 representing the mini lot size is 10,000, then 4 representing the micro lot size is 4,000, right? You add them together, that will give you 14,000. Okay, so we have 14,000 right here, so this ought to be 14,000, sorry. So you multiply, then divide by current market value, and that will give you your risk, your dollar per pip. Okay, that will give you the dollar per pip. So multiply by your stop loss. Okay, that's $1.3 times 20 pips. That will give you $19.4. Okay, that's still within our our risk per trade. Okay, that's still within our risk per trade.